All right, greetings to all you traders out there. It's Sam here from TradeDevils-Indicators. I've got a little training series here prepared for you. Now, our focus is going to be on back testing. Oh, I got a long weekend here. Seems like a good time to maybe do a little back testing of whatever it is that you're doing. Now, we're going to feature our manual back tester, right? Which makes it easy to do this. And that is available, right? We're having a little promotion this weekend, so that's something to consider. You can also trial it, right? We always want to encourage you to trial things before you make an investment in them. But we're going to do this back testing, and I'm going to feature our graphical order flow package. Now, I'm using the graphical order flow package, which is what you see here on the screen here. It's a good hybrid of many of our most popular tools and indicators, and it's almost Swiss Army knife of the TDI tools, and we've updated it recently. So this is it's a chance to demonstrate some of those new features and how you can apply them. But I don't want to get caught on that just yet. Let's keep back to our focus, which was we want to back test. So again, this is the graphical order flow that you see here. Now, I do have a couple of additional tools on this, as I always do whenever I'm recording a video. I've got our toolbar here, as I often will grab things from that. And then additionally, I have our initial balance indicator on it. It frames the day for us so we can see the open and close of the RTH session. But also, these are... if you know the material that we teach, right? These are by far the most important levels on the board, right? VWAP, okay, yeah, that's important as well, but nothing more important than the initial balance. But I digress. Okay, so as we look here at a 1 minute, now I'm just using that's this Friday. As I always do, I just use the most recent data. I never cherry pick data. There's never any need to. Okay, so before we get into everything you see here, because there's a lot going on here. I thought I'd show you this. Now, I have to say that I got this idea from another educator here, and I'm going to borrow it a little bit. This is a little Google research I did here. So this is, I've just typed in here smart money concepts. Now, this is, without question, the most popular approach to technical analysis, certainly within the last 5 years. It's really quite remarkable because there's nothing new to it. It's entirely a marketing creation, and I have to give just massive props to the guy who did this repackaging, marketing, etc. And that's ICT. We'll look at that in a second. But look, smart money concepts. That's 431 million results. 431 million. The guy who came up with it. He goes by ICT. ICT 172 million. How about something that's been around for, 100 years? LA wave trading, 14 million. Smart money concepts, 431 million. LA wave trading, 14 million. Interesting. How about support and resistance trading? Well, we're getting up there. That's 120 million. Now, looking at all that, how about back testing? How about back testing futures trading? 1.2 million. How about just back testing just futures? See what I get there. 4 million. 431 million, 4 million. Where's the focus? Right, so as people are, trying to figure out how to trade, perhaps incorporating some back testing into what you're doing is something to consider, right? Which is why we want to kind of focus on that here as we're looking at the new version of our graphical order flow package, right? Now, it happens to have built into it some smart money concepts. It's not a complete market structure SMC tool suite. We make that available through our market structure indicator, but it's a good hybrid. Again, you've got so much in here. It's really a cross section between market structure, smart money concepts, swing trading, momentum trading, and pulling out some of the advantages that come with a footprint chart. So without the bid ask within each candle. So there's a lot going on here. We're going to break it apart one piece at a time. Again, this would probably be multiple videos here so that none of these are too terribly long. But for those of you that, I should mention, we've got to go through just a little bit of basics here. We have just a whole lot of new members. In our Discord, our email list has doubled in the last 60 days. So it just a lot of people that may or may not have been exposed to this. So now, given those Google results, likely you've been exposed to this. You've seen a video or a training or some commentary or something along these lines. But just on the premise that I can't assume that everybody's familiar with it here. Let's just do some very rudimentary basics, right? And again, out of those 400 million results, they're all going to teach it to you the same way via line drawings. Okay, so here's our basic uptrend. Now, smart money market structure, we're not changing how we're defining a trend, right? We've just added some lingo here to kind of sex it up. So oh, you know, what was swing high, swing low is now weak high, strong low. And it's not like it doesn't make sense. It's not logical, right? So let's just do the most rudimentary review of market structure here. And again, this is not a training series on smart money concepts and market structure. If you're not familiar with it and you have not been to one of those 400 million pages, to learn a little bit about this, we do have a full, I mean, if you want to get into a detailed review of at least how we interpret and how we explain market structure, well, there's 15 videos in here walking you through a lot of trade examples here, the theory of it, as well as some recent updates that we've made to that indicator. So that if you really want to dive into it, that's a reasonable place to start. Mine, along with 10,000 other channels that will have similar information. Oh, I should note here, this is over on TradeDevils-Indicators YouTube channel, right? So just so you know that that's there if you wanted to dig in, plenty of meat for you to chew on there. Okay, but let's just come back to our very rudimentary example here, because since we're going to do our back testing on the graphical order flow package, it does have a very emphasis rudimentary market structure built into it, right? So remember, it's a bit of a cross section between 4 or 5 different indicators that we make available to you. Again, that's why I kind of think of it as a this, for lack of a better term, the Swiss Army knife of all of the TDI tools. So, just because it's simple doesn't mean it's not effective. So what we're going to do here in the foundation of this will be tied to the very basic presumption that we make when applying market structure. And that is, again, it's very, very simple, that when we have a series of swings like this, and again, just to come back to visit the idea, let me actually use the arrow here. So when I've got a swing, I get a retrace. Now, when I come up and break this high, this becomes the strong low. This becomes the weak high, right? And that just continues. Once I get the break here, this is foundational. Once I get a break of structure, I am anticipating that I'm going to get a retrace, right? So that's the premise behind this, and that will guide us through all of our back testing. So break of structure. Now, there's no telling how high this can go, but we're just, for the interest of just making an example here, once we start that retrace, of course, we don't know, right? You never know. We could have a trend change here, but the premise is that because money was committed to here, and it had to be committed with aggression to break this high, because of course, just if you think about the other side of it, right, money had to be committed here to drive the retracement, right? So buyers have to overwhelm that aggression with their own aggression here and demand to move past that prior high, right? So this becomes weak, that's strong, right? Because this was broken, this is held. Now that we get up here, we don't know that that's going to be a weak high at that moment in time. It only becomes a weak high when it's broken, right? At that point in time, it's just a high, right? So now we could come down and do that. So that's foundational to the entire premise of market structure, whether we're talking about a very sophisticated application like our market structure SMC indicator suite. But for our purposes here, all we're focused on, if I get a break of a swing, I'm calling that a break of structure. And that's exactly what the graphical order flow it's built into the order flow zigzag. That's all it does, right? It's just identifying when we break structure. So if I come back here and we just carry this on, if I were to get, well, let's just keep it simple, right? If I were to get something like this right here, well, of course I've had a break of structure. I want a line, right? So I've had a swing break here. So the order flow zigzag, it's going to do that for me every time. Order flow zigzag is going to call that a break of structure. Now, there's more detail to if you wanted to go deeper into market structure, because one question would be, oh, okay, is one little break here, is that truly a break of structure, or is that just a change of character? Again, I want to get into an entire, because we could be here for 3 hours. We're just going to call it a break of structure, right, for our purposes here. So if we come down here, okay, well, now I've got a second break of structure. So what's happening now, this becomes the strong high, right? That would be the strong high. This becomes the weak low, and the process and that labeling reverses. So if we, oh, come here, right? So if we come down here and we break here, well, now you'll start to notice that I have the potential for a trend change here, because now I've got a lower high and a lower low. Now that doesn't mean, of course, we could here, if we just apply some fibs, right? That doesn't mean we couldn't come down here, and then as we come to some support, there could be a candle, could be demand, could be a gap. There's all sorts of reasons why we might pivot here, and that trend can carry back on that direction. So it's not a, of course, it's all just probabilities. There's no guarantee here that we aren't going back up to visit and take out that high, right? Which in this scenario here, this is now the strong high. Weak low, strong high, weak. Well, this one is undefined, right? It's a low. Until it's broken, it remains in flux. So for our backtesting purposes, again, not to digress into a whole market structure training, again, that content is on the YouTube channel if you're interested in that. We're just going to keep it drop dead simple. So if we break here, break a structure, break here, break a structure. Now if I come back up here and I break there, again, just another break of structure, right? So we're not going to complicate it for our backtesting purposes here, and I think you'll be pleased that you don't need to complicate it to get a good result. So break of structure, break of structure. Anytime we take out one of these swings, we're going to call it a break of structure, and that's, well, that's exactly what the software is going to do. So we're going to trade based on the last break of structure. Now, in that, and we'll address this in a bit of, I guess we'll use the market structure language. Oh, let's see. Here, I'll do it this way. So whenever we get a break here, and we get a break of structure, and we're anticipating the retrace, the range that we have here. Oh, let's do it this way. The range that we have here, this swing structure here, is called a PDA, a premium discount array, right? It's again, right, this market structure language, right? Again, it's just trying to make something that's kind of boring. How can we sex this up a little bit? Oh, we'll call it a PDA, right? So it's a premium discount. And the theory being that if we have an uptrend here, we want to buy, right? If you think of it this, again, not to, it's drop dead simple, right? So, okay, we're going to buy under the 50%. That would be the discount. If we want to be sellers above the discount in the premium, right? So that's the entire theory. So if you take the same, here, let's come here. So if I do it this way, right? Same idea. If I pop this here, okay, right? So I only want to be selling in the premium here, right? Once I've had that first break of structure, I want to be selling beyond the 50% in the premium, right? So each time I get a new swing, I get a new PDA, right? Now, of course, we can come down. Oh, here, we can come down and break that. Wicks can go through, but for a true break of structure here, again, I'm getting a little bit sidetracked here with some of the nuance here. A close below really confirms it, right? Because you want to be mindful of something like just a stop run here, liquidity grab, as it's called in market structure language here. Because every one of these pivots, right? Of course, we all know this, right? Every one of these pivots is going to have stops underneath it, so it's a potential source of liquidity, i.e., stops can be run, right? So if they want to take it up, right? If algorithms, right? Because this is all algo driven. If algorithms are they're looking to take this up, what they need to grab some stops here to grab the fuel to do that. So that's why you'll often see, it's very common to see sweeps of pivots, because it's a place for the algo to grab a drink, right? Of liquidity. So we'll look at that as we go into real world examples. But just for the theory here, again, break a swing high or low, break a structure, right? Again, drop dead simple. And then for our backtesting purposes, we're only going to take trades in the premium or the discount, right? Whether we're buying or selling, right? And we're going to use some of the tools in the graphical order flow to help us make better decisions, right? Or time those decisions based on what we can see, right? So this is just idealized swing structure here, but it's not too terribly far from what you're going to experience when you look at the markets, right? What makes this easier to follow is we don't have all the bar chop to kind of create some confusion in your mind's eye. So let's just go over here. And I've done trainings like this before, but I think it's valuable, particularly, again, we've got a lot of new people here, maybe you haven't seen that, but this is a valuable way to kind of, okay, understand this, down at the skeletal view. Okay, what's really happening here? Because as soon as we put the bars on, it's easy to get lost in the confusion. Now, I'm going to put the bars on just for a second to show you that this is here. I'll just use candlesticks here. These are actually nailing the swing high and swing low, right? So it's not like, oh, you see one of these and, oh, a big wick goes through and would take out any resting positions there. These are swing highs and lows. So just so you recognize that. And again, all I've done is just make the line transparent here so we can look at. So here's the reality of it right now. You'll note here, and I've highlighted these to kind of emphasize this. This is the order flow zigzag that's built into the graphical order flow package, what we're going to use for our back testing. So what you'll see here, I got to open this up to get that text. Oh, these are a little too scrunched up to get the, oh, there we go. All right, so if I open it up here, you can see there's a break of structure. So again, this is very, very rudimentary market structure, right? If we take out a swing, break of structure, right? If we take out a swing here. Now, again, back to our premise, which you'll recall, is that if I get a break of structure, we're going to take the next retrace as long as we don't break the prior high. So anything, if I do it back to our example here, if I do it this way, right? Anything, if we've had a break of structure here that would have us, well, we can use this as an example here, actually. Just bring this over here, right? So, oh God, is it going to let me do that? No, it's not. All right, so here I'll just use fibs, right? So here I've had a break of structure, right? Well, pardon me. Let's do it this way. Let's get it right. Come here, right? So here's the break of structure. So the next thing I'm looking for is the retrace. Now here's the 50. So we'd be selling in the premium. Right, it's as simple as that. That's all we're going to do in this back testing, right? Drop dead simple. So for example, here I've got a break of structure. You'd be looking at that moment in time. You don't know what's coming, right? So when we do our back testing, right, you got to be, don't be easy on yourself. Be hard on yourself, right? So here, okay, are you going to take this trade, right? We've had a break of structure. Here's the retrace. It goes into the discount, right? So here's our discount under the 50, right? So we're in our discount. Are we taking that trade? Well, for our purposes here, yes, because we don't know that's coming, right? We're over here. We don't know that's coming. That's all we've got, right? So we see that I've had a break of structure. There's the retrace. I'm in the discount. Yes, we're taking that trade. Now we're going to add a little bit of technical confluence to this because we're going to start adding some of the components. Remember, this is where we're headed, right? And that, oh, I think that is that break of structure. We're going to add some of that technical support to help guide us in those decisions. But for the most rudimentary application here, if I see a break of structure and I retrace into discount, or a break of structure and retrace into premium, we're going to at least look to see if all of the conditions are there for us to enter that trade. But here's the reality, right? So it's what's different is that it doesn't have the perfect idealized swing structure, right, that you see over here. But it's essentially, that's what you're looking at, right? This is just the real world of it. Now this is a 1 minute on the S&P, so obviously you're going to have plenty of volatility. But we're going to look at this over a couple of days and see if we can't come to, some sort of meaningful approach here. And be perfectly honest, I have not backtested because I'm not worried. I think we're going to find a good result here. We're going to use just very basic stop placement and management here. I think we're going to use a 12-tick stop, and we'll use some logical exits for our targets when we do our back testing. But again, I want to just kind of show this to you one step at a time so it's very clear. Break of structure, retrace. Yeah, I'm interested, right? So this would be an area of interest, right? But note here, we don't get that many breaks of structure here, and even on a 1 minute, right? Here's a break of structure. If we come down here and retrace, yeah, I'm interested, right? We're gonna take a look there. Now here's another, pardon me. Here's a break of structure coming here on this. Yeah, I'm interested. Break of structure here as it comes down here. I'm looking. I get another break of structure here. I'm interested. Right here, I'm interested. Okay, yeah. So just so you have the basic theory, this is foundational to what we're going to do, and just bring you back. All right, we won't go through the overnight, right? So I got to scroll. There's so much, right, in the disadvantage of a minute chart, but that's all right. Thursday, same kind of idea. Here, so you see some of these are pretty striking, right? Break of structure, retrace, I want that trade. Well, I'm interested in that trade, right? Break of structure, reach. Well, here we've got, this is something you'll see often around these swings, and this it can be really helpful to kind of look at it this way. You can kind of see what's happening here, right? So we've got stops here, we've got stops down here, right? Odds are that both of these are going to get swept, right? Because it's liquidity, right? It's just liquid. The tightening swing structure here, liquidity is building up on both sides, right? So this the top side gets swept, bottom side gets swept, and then the trend expands, right? So you look here, oh, that's coming up. That's right after Europe's close, right? We go into a little chop. This is, again, this is Thursday, but you can kind of get a sense of now. One thing you're going to notice here, which if you haven't already, is hey, what's going on with those diamonds? Because they sure seem to be nailing the pivots. What's going on there? Now, it's not on every pivot, right? Not on every pivot. But when you see it, boy, it sure does seem to get the turn. Now, that's part of our graphical order flow package, and we'll get into that. But that hopefully that caught your eye. Like, oh, wait a minute. Now, okay, we break it, right? But pretty good on the turns, all right? So we'll come back to that in a second. Okay, so let me let's see. So what I'm going to do is just start adding components, right? As I've shown you a couple of times, there's a lot going on here. This is the full graphical order flow, fully complete, right? So I'm going to start just adding pieces one at a time. We're going to try and keep it relatively simple. This is a 21 McGinley. We're going to kind of use that as a base case. In fact, we're going to start with just adding that, and then see how that affects our determination of where we might be looking. So we want, right? If it's red and we get a buy signal, we may want to reevaluate that until we get on the other side of green, right? We'll look at that in a second. All right, so I'm going to pause this here because I don't want these videos being too long, and then we'll start assembling this tool suite, this order flow package, one piece at a time, and then we'll start doing some back testing and see what kind of result we get.